Okay, Patrick, a big part of what I love, what you were talking about last night at the seminar, was this whole concept of A, B, C, D property. Is there an E? Sorry, it's D.
Just D.
Just
A, B, C, D.
Can you just take us through that?
Yeah, we could break it down further, but I don't have
Let's not go to Z.
We could go. Essentially, what over the years of doing this and with my research, we found that every suburb, and none of them are immune to this, and you've got A, B, C, D grade real estate. So A, I classify as top 10%, top tier. B, next 20% tier. Okay. C, next 40% chunk. And D, the bottom 30.
So if you looked at suburbs of Sydney, what's an A and what's a D?
Oh, suburbs. Okay, so you've got macro markets. So you might say, you can break that down bigger. So you could sort of say, well, the lower North Shore or the eastern suburbs, they're A markets.
Okay.
But within those A markets, there's A, B, C, D still
Sure.
real estate. So if we went and picked on a typical lower North Shore Sydney suburb of, say, Mosman, it has A grade property, it has B, C and D in it, in that percentage.
Okay.
Okay, because you can classify it for each suburb.
Depends who's developed what project in that suburb.
Yeah, and it's a lot about position, location, and things like that, and then we can break it down to A, B, C, D grade in condition.
Right.
Okay, so we could buy A or B grade positioned property, okay, and that doesn't mean the one right on the main street. It's often the 2 street back.
Right.
Access to all that,
Right.
but not right in it. Okay, so that as an example. But then we could buy that in a D grade condition. We can bring it up to an A or a B grade condition through a renovation service.
Right.
And then we've got a fantastic property that we've added value to and increased our capital value. Okay, and increased our rent return. So breaking the ABCD thing, so essentially you want to be in that A or B grade, that top 30% of real estate. That's the only thing that I'll pretty much allow a client to buy if I'm acting for them. Because it'll always rent well, when the market's going well, you get the best of the capital growth that's going on in the market, you'll get best rents, and when the market's tough, it's going to be performing better than average. It's that top high quality real estate.
Got it.
Okay, you're going to have to pay market value for it. If you want to, the A grade stuff, you're going to set the new benchmark. You're probably going to pay 5% more than what it's worth today to own it because there's so many people wanting it.
But long term, that's obviously the quality.
It's fine to do that.
Yes.
If it's your home and that's where you want to be. For investors, we try and stick with the B grade only, whereas home buyers will buy A or B.
Sure.
Whereas investors will stick with the B grade because we don't want to pay a premium, but we're happy to pay up to market value to get a quality piece of real estate that'll outperform the average. Because if you've got an average, okay, say the market goes up 8%, then you have to have a market where property is performing above and below to have an average of 8. So you could have the A or B grade real estate performing at 10% growth, whereas the C and the D is going to perform at 8, 7 or 6
right.
to bring up an average of 8. And that's what sort of we see happen in the marketplace. And it's the same with rents. Okay, you'll get the better return on your rent. So when we do go back and the market does a cycle over the next 10 years and we end up with vacancy rates again of 3.5%, 4%, you want to have a good quality property that's going to be rented all the time and still get good rent. And that's what's very important about it.
And this is a big part because many of the clients who receive this newsletter and know me, we don't like buying the marketeers that come up from Australia and they're selling the off-plan 500 apartments that are high-rise that we have here in Hong Kong. But of course, we have to do it here because to buy a house is so expensive. It's a very different market. But back in Australia, people are buying these C-grade properties expecting to make oodles of money, and they just don't experience any capital growth for 10 years.
No, and that's very common. And I could pretty much, I haven't seen too many of these high-rise developments off the plan. I mean, the reason they're coming up here and flogging stuff off the plan is because no one in Australia is going to buy it.
Yeah.
And they're not quality, in my opinion. It's not what we want. It's not what gets good growth. We don't buy it, never have, don't intend to. It's really steer clear from it. It's good to buy. I have bought brand new property and I have bought off the plan property before, but in a smaller block, more boutique-y. It's very specific. It's not easy to do and get right. But in general these days we mainly focus on buying property we can add value to and increase capital growth. Because if you buy a brand new property, they'll sell you on tax benefits and things like that. They'll see with rental guarantees, by the way, if you see a rental guarantee,
all the books.
Run a mile, rental guarantees, you're paying a premium.
And I get very concerned for these fully furnished, 100% serviced apartments. People,
clear of it.
getting in danger with this and getting a high depreciation schedule from the accountant, but 3 years later it's gone up with inflation.
Yeah, look, stay away from it because my experience is that it underperforms.
Yeah.
We could do a lot better. A lot better. And tax breaks are fantastic as a bonus. They're not a reason to buy.
Perfect. Okay. Just keeping our eye on the clock. We've got another 5 minutes. One of the things I also wanted to bring up was that when I've looked at buyers agents, and I have different buyers agents in every state around Australia, and use Patrick wholly and solely for Sydney, was one of the big value adds that Patrick's business does that I haven't seen in any other practice in Australia, by the way, has been the ability to do the property management of the building or the property, as well as a value add with adding value for renovations and project managing the building or the renovation of certain properties. And I've seen it happen where clients buy a place, they might try and fix it up themselves, but having someone that actually can do all that in-house whilst you're buying and adding that value is a huge, huge service that I see adding value to our clients. And in a previous life, Patrick actually was a builder, and so he understands what the whole building trade involves. So perhaps you could talk a bit about that.
Yeah, well, look, that's an area that we've that's sort of expanded in the business, mainly due to demand of clients, because I'd find really good properties, and my team would, and we'd find these great properties that needed renovation, and we say, you should buy this. You've only got to put 50 grand into it. For every dollar you spend, you should get 2 back. You'll add 100 value to it, and they'd be like, oh, that all sounds great, but too hard basket. I don't know what I'm doing. And so after being frustrated from our end, trying to get people to do these deals, and was suggested as well, you do it. And so we've actually got a full-time team.
You get all the staff in-house that do this.
Yeah. And so we now project manage. We've been doing it for a couple of years now, and it's working really, really well. And we just project manage the renos. And essentially our mandate to do it is that we want to spend $1, but we want 2 back in capital value, and we want to increase the rent. In most cases, we can increase the rent enough to cover the interest payment for the cost of the renovation. So if you borrowed $50,000 at 7% interest, I know you can borrow it a lot cheaper than that up here, but and it is only at 5.8 at the moment, but let's just say 7 for ease of numbers. That's $3 grand a year interest payment roughly. Well, we've only got to increase the rent to $60 a week with a renovation to cover that, and in most cases we can, as well as doubling the amount of money you put in. And that's good for me and good for the client, because what we want to do, I'm in the business of buying more properties, managing more properties, and renovating more properties. So I'm happy to be doing that, and the client has another property that's growing in capital value, that's growing in asset value, and adding to their portfolio. And we're using that manufacturing, as I call it, capital value, to take that equity out and go and use it as a deposit for the next one. So they're able to get into another property often 2 years or 3 years quicker than they would have otherwise been.
Which is, quite often the case for the clients up here earning obviously higher incomes in US dollars, and with their velocity of wealth building, they're buying a property every 24 months. So this sort of strategy enables you to take that equity and get into the second and the third property, which is really what we want you for, to build that capital growth. At this point, clients don't really need the income whilst we're in Asia, so they're really looking for that capital gain. And that's why I think it was an important point to mention that, because no one else I see in Australia is actually doing that. Okay, last 30 seconds. The marketplace now in the next 12 months, where are we going?
Well, I just think it's going to be a fairly level to improvement. I don't see the market getting any worse. Obviously, that's dependent on world economic influences. But as going forward with what we know now, I think we're going to see improvement. I mean, we've seen already a couple of percent this first quarter of this year, and I just think that's going to continue along. We've got a very good supply and demand problem to have if you want to buy real estate, and that's every capital city pretty much around the country, in the sort of mainly Melbourne, Sydney, Brisbane.
And Sydney for its A-grade properties in the next 12 months, you still see them holding their value?
Yeah, well, look, they will. That's the thing about buying A and B-grade real estate. You want to be in that because it's the last to feel the effects and the first to pick up the benefits. One
final thing, I just had a hike with Patrick on the weekend. One of the biggest things he was taking, we rolled his ankle too, by the way, but one of the biggest things he was telling me was the largest frustration right now is finding good stock. Yeah. So, that really shows what's happening in the marketplace. The good stuff is not selling because people are staying. So with that, we thank you for tuning in, and we'll catch you in next month's Informer, and thank you, Patrick.
Thanks, Todd.